Good morning, everyone. My name is Chad Schmidt. I work in commercial sales with Chicago Title. First of all, I'd like to thank everybody for joining us this morning. Looks like we have another outstanding turnout, so great to see. This is our 8th continuing education class that we've hosted here in 2022. And one quick announcement before we begin our presentation today. If you have any questions, please utilize the Q&A box at the bottom of the screen. I will field each question as they come in throughout the presentation. And I'm very happy to have with us this morning our guest speaker, David Jaffe, who is a tax specialist and senior national representative with CSSI. And he has been with the company since 2016. CSI is a company that was founded in 2003, and they have completed over 30,000 studies for commercial property owners covering all 50 states. So now I'm delighted to introduce to you our guest speaker, David Jaffe.
Thank you, Chad. Good morning, everybody. I hope you're able to see my screen with the overview. I want to actually cover 3 different things today. They are all based on the fact of getting money for commercial property owners of whatever sort. And I understand we've got a mix of folks here. So we've got some brokers, some lenders, and some actual investors. So I have tweaked this a bit so that I can appeal to all of you. And I hope you enjoy it. Ask questions as we go along, please. That's perfectly fine with me. Chad will just let me know when I've got something to answer. So that's my splash screen. And that is me. There will be another one of those at the end. So I actually want to cover 3 things today. The slide shows cost segregation, and it's the basis for everything that we do. But we actually get people optional tax deductions on 3 different ways. And the point is improving cash on hand, lowering taxes, whether now and in the future. The 3 things are going to be cost segregation, which is what brought you here, which was created back in '97. And that is accelerated depreciation, okay, as it applies to commercial buildings. And that is a pure timing play. That's a time value of money thing, getting you deductions years or even decades earlier than normal. Now, that is used as the basis for 2 other deductions. Even folks who know about cost segregation tend not to know about the other 2. The other 2 being the changes in 2014 of the IRS repair regulations. They have made them easier to figure out what can be deducted and what can't, and they've made that more generous to the taxpayer. They've actually made it retroactive. So you can have repairs that you've capitalized in the past be pulled out of the past into a current year deduction. They've also made them mandatory. So they've certainly added a lot of carrots as incentives, but they've added a stick as well. There are penalties by not doing this right. So you want to do it right. It's literally in your interest on both the positive side and avoiding negative sides. And the third is the partial asset disposition. You might think of it as trash to cash. So when you do a renovation of a building, you can actually get deductions on the things that you have thrown away or you can't use. For example, they call it abandoned in place. There might be an HVAC system up on the roof that you can't use. You don't even bother taking it out, but you're not using it. You're able to deduct that. The beauty of this is you get additional deductions now, plus ultimately you will lower your tax burden at the time of sale. And unlike these other 2 things, that is something that has to be taken in the year incurred. So you can't wait on that. Everything else you can do in later years. These are complex issues, but there are huge benefits. And the thing is, you cannot expect CPAs to know enough about this stuff to do it. I will cover this in a slide. Don't assume that no matter how good your CPA is, they are pulling all the dollars off the table with the IRS. You really want an expert to take a look for you. The question, who can benefit? Both businesses and landlords. When businesses have their own business or they're renting space, that's their money to deduct. Landlords, obviously, it can be a recently built or purchased, but frankly, also owned for many years. We have things penciling out that people have owned for 20 years now. So it's worth a quick look-see, as they say. Owners and tenants, if you have a tenant situation and they paid for their own build out, they can apply this tax strategy. Estate planning and trusts is a big one if there's any planners out there for this, because one of the things that happens is you get these deductions years early and there's no recapture if it's handed down to your heirs. Triple net lease tenants and owners. Again, you have dollars in buildings, you can deduct it. These are optional deductions to help your cash flow. I help folks with one single family rental, but no big surprise. The more stuff you own and the larger it is, the more you can get from it. There's a list of buildings there, building types. They're not comprehensive. I mean, the fact is just about anything other than a pole barn is probably going to pencil out for a cost segregation study. But hopefully this gets the wheels turning in your head. Hospitals, franchise, restaurants, strip malls, storage, single family rentals, Airbnb, hotels, all this stuff is going to qualify. Now, some of you are actual advisors and some of you are investors. So for the folks who don't own a building themselves, you want to tell your owners about this. You are going to help your clients retain money that also otherwise would have gone to the IRS. And who cares? Well, the extra cash in their pocket means they can probably buy more real estate. They can do renovations. They've got working capital for whatever they want. They can build this into their plans going forward. If you're a lender, you will find that they are more able to stay current on their loans, or they're running their business in the early times when it's the toughest out there. Cash flow increased in the early, riskier years of business and building ownership. That's what this is about. Although there's some benefits on the tail end too when you sell. Cost segregation itself. Very simply, it is accelerated depreciation, which you are allowed to get on your rented building. You probably know that there are two different tax lives. Either 27.5 years is a tax life on a building that's long-term residential rental, 39 years on the rest. But cost segregation is actually the formalized study of identifying building components that you can write off faster than writing off the building itself in that big lump of 27.5 or 39 years. What this turns into is lower taxes for the owner. Importantly, it's also an input calculation for the other things I'm going to tell you about, which are additional on top of this deductions. So building owners keep cash now instead of getting deductions far in the future. And who wouldn't want it? Not only do you get to use the money, but $1 now versus 20 years from now with inflation and everything else is a lot more useful to you. Who would say no? Unless there are catches, and you're going to find there are almost none. There's a number of ways of doing cost segregation. The IRS calls an engineering-based methodology the certain method. They trust that over anything else, including having a CPA sit down with all the receipts from a brand new building and adding up the pieces. The IRS prefers an engineering-based study. It's something to look for when you look for using someone for this purpose. So what is going on in IRS speak is we are taking a building which is considered real property, or as IRS calls it, 1250 property, and we are pulling some portion of it into personal property, i.e. 1245 property. And once it is personal property, all of a sudden it doesn't have a 27.5 or 39-year tax life. All of a sudden it has a 5 or 7 or 15-year tax life. So do the math, $100,000 written off in 5 equal increments versus 39 equal increments is a big deal. And what you're effectively getting is an interest-free loan from the government. Okay, so if you kept the building for 39 years, you would be able to depreciate it 100%. However, This is giving you the ability to depreciate a lot of it very, very much more quickly, more cash flow for you, and that's the point. Conceptually, it's nothing different than what the heck is a Big Mac. By default, with straight line depreciation, they look at it as a $4 hamburger. Once you go through the cost segregation process, all of a sudden you've put value to the components, the patties, the sauce, the lettuce, the cheese, etc. And that is in fact important because while the burger patties may last for decades, they've found them in landfills still looking like burger patties, the lettuce is going to die off and rot quickly. Just like that in a building. The building shell you can expect to last for 39 years, but the carpet, the paint, stuff like that, of course not. So what happened was in 1997, after a bunch of other court cases, there was a court case called Hospital Corporation of America versus the IRS. And HCA owed $800 million in taxes. They went to court and they said, look, Your Honor, we have all this money in carpeting, specialized paints, all these interior finishes, cabinetry, desks, all this stuff. It's not lasting 39 years. It doesn't make sense to depreciate it over 39 years. The judge said, absolutely, IRS, you have to go back and make a method allowing taxpayers to depreciate this stuff faster. They did. They gave it the name cost segregation. That's all we're talking about at this point. So this gives you an idea of some of the things that we pull out. Interior doors, interior walls, partitions, and windows, decorative elements, a lot of specialized things like electrical and plumbing, carpeting, flooring, molding, cabinets and countertops. The way I like to think of it is the shell of the building is set on its tax life, but things attached to it on the inside, many of those can be pulled out. And effectively what cost segregation does is figure out how many dollars you have on these interior pieces and then pulls them out separately on your depreciation schedule so that they can be given a 5, 7, or 15-year tax life. Now, if you want to look at this graphically, what's going on? You can depreciate a building 100% by default. It's the tax life of the building. The area under both of these lines is the same. It represents 100% of the dollars that you have in the building. Don't forget, land itself can't be depreciated. So you spend $1 million for a building, you have to pull out the land, but probably $750,000 is assigned to the building. All those dollars are represented under the lines, but wouldn't you rather have the red line working for you where you scrape a lot of those dollars off of future years and throw it right up front in the first couple? Short answer is yes. That was a rhetorical question. Now, a lot of people say it seems too good to be true. That's one of the biggest pushbacks I get. I've never heard of it. It sounds like a loophole. I certainly don't want to trigger an audit. Just so you know, you will not trigger an audit. The IRS not only accepts, but actually recommends that you do cost segregation. I'm not allowed to put it on the slide, but the quote from the IRS is, as a practical matter, cost segregation studies should be applied by taxpayers. I'm going to show you a couple quotes from national accounting associations and entities. It is not a loophole. It is not anything to be scared about. People, with a few exceptions, because there are reasons not to use it, people should be regularly using this, and at least half the people I run into have never heard of it. It does not need to be done at the point that you buy or build out a building. It can be done at any point in the future. What you do is, after depreciating a building straight line, normally for years, you have to tell the IRS when you make a change and you're going to accelerate depreciation, and you fill out a change of accounting method form. It's called a Form 3115. Absolutely accepted, will not trigger an audit, okay? Just a little blurb about us. The company I rep for has been around for 20 years. We've done more than 30,000 studies. We have never triggered an audit. And yes, we have defended our work before, and we've always had a favorable result. one of the beauties of experience, and especially doing a cost segregation study with an engineering methodology. You are allowed to do it a couple of other different ways, but as I mentioned, the IRS calls the engineering basis the certain method. And at least our company stands behind our numbers to the point where we will in fact go and do an audit with you and defend our work at no charge for clients. The couple of quotes I wanted to give you: Journal of Accountancy. Some taxpayers are reluctant to use cost seg, equating it with a high-risk tax shelter. In truth, this reluctance is misplaced. If the cost of the components in the engineering report, notice engineering, is well documented, the cost segregation technique is no more aggressive than using a permissible depreciation method under the Internal Revenue Code. That's a Journal of Accountancy. And the American Institute of CPA says, today, virtually all real property purchases entail the simultaneous acquisition of tangible personal property. For that reason, CPAs should routinely recommend the use of cost segregation studies whenever the expenditures for an acquisition, including leasehold improvements, equal or exceed $750,000. Another little side note, with us, at least, cost seg is usually cost effective at about $200,000 of building basis. One of the other biggest pushbacks I get when I introduce this is my CPA already did this. And the fact is they probably have not done this. There are not many CPAs in the country that can actually do a cost segregation study. They use folks like me. If they do something on their own, they tend to pull out the stuff that they know, the easy stuff. What this example is supposed to show, without giving the total basis of the building, they're starting at the top and saying, you know, if you just use straight line depreciation, you're going to get $104,000 of depreciation expense, and you don't use us for that. It's $104,000, and then we look at what your typical CPA can probably pull out. He can probably pull out $195,000. Instead of using the straight line 104, cost segregation is going to get a lot more. We are going to go in and figure out how much is the carpet on the floor worth, how much is money is tied up in the built-in cabinetry and desks, things like that, things that a CPA realistically couldn't do. And it's drastically more. In this case, we're showing the CPA grabbed you an extra $90,000 write-off, representing, you know, about $32K in cash kept in your pocket, but cost segregation was more than double, and it's frequently even higher than that. A CPA will just pull out something like, you just repaved the driveway. I know that's 15-year property. Good, that's good for him, but that's truly low-hanging fruit. So always have an expert look at it, or otherwise you're almost guaranteed to be leaving money on the table with the IRS. I'm going to mention something that was created in the Tax Cuts and Jobs Act, which they call bonus depreciation. So what I've shown you is breaking a building into pieces, and the pieces that we pull out, this personal property, a lot of it you can write off in 5 years or 15 years. What the 2017 Tax Cuts and Jobs Act did, TCJA, was say, hey, all those dollars that you find, I'll give you a statistic I haven't mentioned. Generally, between 20 and 30% of the dollars in a building can be pulled out and put into the personal property category. So it depends a lot on what's in the building. Obviously, when you've got a warehouse versus a medical building with all kinds of specialty stuff going through it, big difference. But again, 20 to 30% is a good rule of thumb. Here's the sort of difference you get between straight line and cost segregation and bonus depreciation, which is sort of cost seg on steroids. It's every dollar that we pull out can be written off in year one. So an $8 million storage facility that was purchased in November of 2017, which puts it in the range, the time range of using bonus depreciation. In the first year, in calendar 2017, their $8 million, they would normally get a $26,000 depreciation expense. With accelerated depreciation, sort of cost seg classic, The first year they would get 154,000 instead. The second year they would probably get 154 or more instead. And for the first 5 to 7 years or so, you're going to get a lot more than the straight line. But look what happens with bonus. With bonus, in this case, we found $700,000 in personal property out of the 8 million. They got to take a $700,000 deduction the first year. Straight line was a 26K depreciation expense, accelerated 154, bonus 700. So gigantic difference. And just for grins, I went through and looked at the stuff I've done since bonus depreciation started. And I found $27.8 million worth of basis in the projects I did. And we got them $5.04 million in first year deductions. So we actually justified 19.6% of the dollars in their buildings to be deductible the first year, 1/5 of what they spent on their storage facilities on average. Some were climate controlled, some not. That makes a difference. But that gives you an idea of the sort of numbers we're talking about. So, do we have a question?
Yeah, hi, David. So we have a question from the audience. I heard that if you use cost segregation, whatever year, you would have to sell the building soon after because there is no depreciation left and because there isn't much left in terms of tax benefits for the remaining years.
Well, good question, but not actually true. I'll jump back a couple of slides so you can actually see what happens over time. This slide right here, straight line depreciation is that blue line. I can't quite read what that number is. It's about $70,000 a year that they would be writing off each year using straight line. Notice in the beginning, you get a whole lot more, but then future years, the first, it looks like 5 or so, you're still getting about 68,000 a year instead of 70. And then in future years, it goes down to what? It looks like 60 instead of 70. So it's definitely not true that you're getting it all up front. This gives you a really good graphical use. And remember, you are getting all of these dollars. You're just getting a lot of them early. And who would rather have $1 in 2048 if they could have $1 in 2014? It just doesn't make any sense. You get to use it in the meantime. And the IRS charges you nothing for this. In effect, you're getting an interest-free loan. You're allowed to do it. Your only expense is paying a firm like mine to do the study that creates the justification for all this. Do you have any others for the moment? Okay.
I think we're
Cost
good.
segregation, huge, worthwhile in and of itself. It's been done since 1997. But it's actually the basis for a couple more things I'm going to tell you about, a couple more deductions I'm going to tell you about. So this is not officially an old slide, but the CARES Act came out, as you know, because of COVID. Tax Cuts and Job Act came out under the last administration. CARES Act, I'm pretty much going to skip. Tax Cuts and Job Act, although it did a lot of things, the biggest thing was creating bonus depreciation. And it's sunsetting, just so you know. So 2022 is the last year that you can bonus 100% of the dollars that we find and apply it to the very first year of ownership, or actually officially the first year that you do it. Because if you bought a building in 2017 or 18 and you do a cost seg in 2022, I'll mention this later, all those benefits that would have flowed to you at that point, anything you should have gotten for tax year of 2022 and prior, you're going to get. It basically all pulls forward into the current year. And again, right now, bonus is at 100%. Next year for 2023, if you buy a new building, it's going to be, you're allowed to take 80% all at once. So it's regular cost seg, but you can take 8 out of 10 of those dollars. And it's sunsetting. So in 2024, it'll be 60%, the following year, 40, 20, and 0, unless it changes. Okay. So remember, cost seg was worth doing before bonus depreciation ever existed. So bonus is important because that was part of the TCJA. What I want to tell you now is what used to be called the TPRs, the Tangible Property Regulations. And now it's basically everyone calls them the IRS repair regulations. So it is something else you need to know about. And you'll find even people knowing cost seg don't know about the tangible property regs, the IRS regs, the changes. It's considered the biggest change to real estate tax law since 1986. So the issue is, how do you treat repairs versus what you're forced to capitalize? Everybody wants to take a deduction now versus having to capitalize it and then depreciate it. Even if you can speed up depreciation, everybody wants the money now. Who wouldn't? So that's the decision. You spend 50 grand fixing your HVAC. Do you have to capitalize it and carry it on the depreciation schedule, or do you get to expense it? There's now it says clear or parens ER. That's because this is drastically better. It's still not 100%. There's still some wiggle room on making the decision. But basically, they are allowing larger deductions to be deducted as repairs immediately versus forcing capitalizing. You get better cash flow out of it. In addition to the carrots of giving you larger deductions, there's now a stick where if you do this wrong, there are penalties, including losing the deduction. They actually want to force you to take the larger deduction and not make it up as you go along. And they've made the law retroactive. So if you spent 50 grand 8 years ago, and under the new rules that didn't exist 8 years ago, it should have been deducted and not capitalized. Believe it or not, they want you to go back and turn it into a current year expense. Take it off of your books, pull it forward, get it off your depreciation schedule, make it into a current year deduction. It's a retroactive tax deduction. You can get a deduction today on money you spent years ago. And the IRS actively wants you to do it. One of the penalties you can get for not being compliant, not using the new method of figuring out what's deductible, they're actually allowed to take the deduction away from you. So yes, it comes off of your books and you don't get to take it as an expense. So carrots and sticks. Ready?
Hi, David. We have another question from Ashton Summers.
Mm-hmm.
Does the 1031 exchange reset the depreciation clock on real property?
So great question. There is a change, and I cover that in a later slide. There is a change once you've broken a building into 1250 real and 1245. Only the 1250 real property can be rolled forward and sheltered. So there's recapture on the things that you've pulled out for cost segregation. It's still not bad for a couple of reasons, one of which is you're going to do cost segregation on your next building and get a giant lump of depreciation up front, which effectively, not literally, but effectively offsets the recapture. But it also can let you get better taxation at the end if you're not rolling forward. And I will cover that, yes. So under the Tax Cuts and Jobs Act, 1031 exchanges were changed in that only the 1050 real property can be rolled forward, not what you segregate into personal property. So what are the TPRs, this 2014 gigantic tax law change? They have made new rules so that it is clearer whether you get to deduct a repair like you want to, or whether you're forced to capitalize it, because that's a decision you got to make. Can I expense it, or am I forced to capitalize it? So if they now have what's called RABI rules. There are things that you're going to have to capitalize. If you're restoring something, if you're adapting something to another function, if you're making a betterment or an improvement, then they're going to force you to capitalize, okay? The second thing is, and this is the biggest one, how do you figure out if $50,000 for effectively the same HVAC unit repair or replacement can be considered a repair or not? Well, they now say you need to look back at the value of that building system, as in the HVAC system for that building or group of buildings. And if it's less than 35, about 35%, their examples unfortunately range from 30% to 40% is allowed, but approximately 35% of the replacement cost of that system, you are allowed to expense it, period. So whereas CPAs used to say, hey, you just spent 50 grand doing that, that's way too big to deduct this year. Now they're actually able to look at how does this compare to the value of the building system? It's only about a third. Boom, we get to write it off, no sweat. Okay. And again, you want to expense it the current year if you can. This new rule lets you create, or create is the wrong word, lets you take advantage of some tax smart repair strategies if you're not doing a betterment. I'll give you an example right now. If all the windows in your building are pretty bad, and let's say they're already double pane, because if you replace all your buildings and you go from single pane to double glazed, that's a betterment. You've got to capitalize that. But let's say you want to replace all the windows in your building, and you're going from double pane to double pane. If you replace them all in a year, you have to capitalize it. If you replace half of them this year and half of them next year, you've fixed more than 50% of the windows, you've got to capitalize it. But if you can hold off and do 1/3 this year, 1/3 next year, and 1/3 the following year, you get to write every dollar off as a repair and not capitalize. Okay? So one of the things that we tell people is how to use tax smart repair strategies. What the heck is a building system? Well, the building system is where you are basically collecting all of the pieces that represent a function for the building. Like electrical, you're adding up the value of the outlets and the wires and the panels and all of that together. So that again, in this case, you've got a $500,000 depreciable cost, but it's almost $800,000 to replace it. If you do a $200,000 repair, you get to deduct that because it's less than approximately 35% of replacement value of that building system. Now, who knows the value of a building system? Your CPA is not going to know it. But once you've done a cost segregation study, you've basically taken the building and you went from one item on your depreciation schedule, which is building, $1 million. All of a sudden, you've got about 60 different line items, and it's going to include electrical outlets and wiring and panels and stuff. So by aggregating those together, you now have a building component value that you can use in this determination. Is it too big to deduct or not? At my company, I don't know other companies that do this. My company actually, with our cost segregation report, do this work for you and hand this as an extra deliverable to the CPA. So he now knows this electrical building system is $791,000 to replace. And now your CPA can look down at it and go, I know I can deduct that quickly. So this is huge, and people don't know about it. They certainly don't know it's retroactive and that the IRS wants you to jump back into the past and pull forward things that you spent years ago. But that is something that we do as part of a study. We will look at the depreciation schedule. It's called scrubbing your schedule to see if there's anything likely that it qualifies under the new rules. Again, new rules apply to old spending and can give you a new deduction today. That actually covers the second deduction that I wanted to tell you about. And the third one is called the partial asset disposition, or a PAD. The way to think about it is trash to cash when you're doing a renovation. And what you're doing is you're writing off assets that are no longer in use, okay? So let me give you a logical example. A building can only have one roof. When you buy the building, the roof is one of the pieces of the building that you've got $1 million in. If you put a brand new roof on it, you cannot capitalize 2 roofs. You are in fact supposed to take off the old one. And you want to take off the old one. And again, I mentioned a stick that the IRS can use is they can take off the old one without letting you deduct the old one. But how do you figure out what the old one is worth, and how can you actually deduct anything from it? So I'll give you some interesting info in a moment. The overview, as you see, is renovations, remodels, and replacements. It also counts abandoned in place. You may very well have some kind of a cooling system up on the roof. You can't use it anymore. It's dead. You are abandoning it in place, but it still has value on the tax side. Roofs, HVAC, electrical are common things. Unlike the other things I've told you about, this is a deduction you have to take in the same year as the renovation. And one very nice additional thing is the removal costs are not required to be capitalized if you do a pad. Otherwise, they would be. So the one example I've got down here, because it's huge, it's amazingly valuable, on every level, and it's something that my company happens to offer, is an LED retrofit for lighting. You would want to do that because you save 80% every year on energy costs for lighting. But you also get the tax, when you get a tax deduction, cost segregation study involved, and you do a pad, the new items, your new LED lights, can be deducted using accelerated depreciation, okay? And you are going to get a credit for the value of the old metal halide or whatever it is system that gets thrown away. So what tends to happen is you actually get all of your money back out of pocket in the first couple of years when you replace all the lighting with LED. And after that, it's just pure profit because your electricity costs have gone down by 80+%. So, partial asset disposition. Very important. You got to take it the year that it's done. Now, this is the interesting thing. This is where reality and tax law completely part ways, okay? Scenario, you buy a building with a really marginal roof. You know it's not going to last very long. You buy it in 2019. If you replace that roof in 2019 or 2020, you have to just capitalize the new roof, and you don't get any credit for the old roof. The thinking being the IRS says, hey, you bought a building knowing that the roof was basically worthless, so worthless is worthless. You spend $1 million, you just spend another $50,000 on a new roof. Your basis is now $1,050,000. If you wait till year 3 and replace the roof, all of a sudden you've thrown out a whole lot of useful life on that roof, because that roof was supposed to last 39 years, but you only got 3 years out of it. All of a sudden, 39ths of the life of that roof you just threw in the trash, and you get to deduct it versus a partial asset disposition, because of course now you have to capitalize the new roof. So again, this is tax smart planning. If you can hold off, may not always be able to, and it is what it is, but if you can hold off, you can get a lot of extra deductions by planning this stuff in advance. I've got a couple of examples here. So just based on what extra you get by using the change in the repair regulations and the ability to do a partial asset disposition, auto dealership is a very common thing where they're throwing away perfectly good stuff for other reasons. The corporation changes the dealer rather changes its color scheme or its logo or its font, whatever like that. So people have to throw out a lot of perfectly good stuff. So in this case, the original building with a cost segregation study, they got an extra $134,718 after tax. But they did a renovation. We got them $53,000 after tax in the demolition, the partial asset disposition, and the renovation itself, that new spending, which was also subject to cost segregation, they got an extra $126,000 after tax. So in this case, they got $314,000, $53,000, which was just the PAD, and the rest was doing a cost seg on the existing building. They could have owned it for many, many years, and the new spending on that renovation. This is real money, folks. Two studies that happened long before I began with the company, but they applied these regulations to buildings purchased back, one in the 90s and one in 2000. But what happens over time, you put in a lot of improvements. And so you get, when you do the cost segregation, you are doing it against everything that is there. And on the case on the left, we got the owners an extra $554,000 after-tax dollars, and the one on the right, it was 1.1 million, despite you can see the small size of the purchases and how long ago they were made. This is a very, very smart way to go, which is why basically everyone recommends it. Or if they're not, there's only one of a couple of different legitimate reasons you don't want to do this. I want to tell you about issues here. Looks like I'm doing fine on time. So the biggest pushback I get where somebody hasn't heard of it, and for the record, fully 50% of the people I talk to have never heard of this. And at least in a third of those cases, their CPA has never heard of this. What kind of issues are there with cost segregation? It's not too good to be true. There's some things you need to know. The first one is the cost segregation portion is purely a timing play. So if you have somebody who's buying something to flip, they're not going to hold on to it long enough to justify doing a study in most cases, okay? They have to keep this after-tax money long enough to at least justify the cost of doing the cost segregation study, which tends to be a couple few thousand. I mean, they start at about $2,000, they go up to probably 10 or 12 or 14, depending on the number of buildings and the size, but that just gives you a range. Cost segregation, by the way, is also a deductible business expense. So just so you know, if you're paying $3,000 for a study, what is it really out of pocket? More like $2,000 out of pocket. So if you're not holding it long enough to save interest by paying down a debt or earn by investing in something, at least your $2,000 or $3,000, whatever you pay, then it doesn't make sense to do it. So if you know you're selling within the next couple of years, 2, maybe even 3 years, generally it doesn't make sense to do it, unless it does, which is, wow, if I had an extra $50,000 this year, it's amazing what I could do with it. Or I'd love to get a gigantic deduction this year because next year, when I sell the building and have to pay it back, I'm going to be in a much lower tax bracket for whatever reason, like you're retiring. So there can be some reasons, but generally, if you're not going to hold it for 2.5 years or more, you generally don't want to. Another thing is the applicability of depreciation deductions. This does not count for the other deductions for repairs, okay? But depreciation is a passive loss. It needs to be applied to passive gains. If you are an investor that does something else for a living, but you're an investor and you're not really making any money at all on your buildings, then this deduction, it doesn't get lost. It doesn't decrease over time. Whatever you can't use flows forward until it's used up. But if you're not making any money to write off against, then cost segregation wouldn't make sense for you, okay? One thing that you may not know, although I've mentioned it, I will mention it again. Anything that you would have gotten by doing the cost segregation the year you bought or built out that building will flow into the current year. So if you bought something in 2015, don't think, oh, it's too late to do a cost seg. It's not. I have studies that will pencil out for people going back. They either bought it or built it or did meaningful renovations since 2002. Those can often pencil out as well. Anything that you would have gotten in the past years flows forward into the year that you do the study. Now, the loss is, of course, that for those years that you didn't know about this and do it, you didn't have that cash to invest, but nonetheless, you've not lost the opportunity. It is worth looking to see if it makes sense on a particular building. Another pushback I get is, yeah, well, what about recapture? Sure, you're going to give me a gigantic deduction now, but if I sell the building, doesn't that get recaptured and retaxed? And the answer is yes, just as it would be with the regular depreciation that you're used to taking. We're just giving you a whole lot more. But once again, if I am going to give you $50,000 in cash today, and 3, 5, 15 years from now, take $50,000 back from you, no interest, no fees, no penalties, no nothing. You got to use it for all that time. Wouldn't you be crazy not to take it? Of course. So yes, there is recapture, but recapture isn't a penalty. Recapture is just taking back what they've loaned you for free all this time. Again, with some possible changes if you're in a different tax bracket. Because the deduction applies now against your current tax bracket. And when recapture occurs, it applies to your then current tax bracket. So we mentioned 1031 exchanges. Most of you who have been investing know about 1031s rolling forward so that you don't get taxed and you keep letting your money build up. So the change in doing the whole bonus depreciation was 1031s, you can now only shelter the 1250 real property, not the entire building anymore. Remember, we've got now one building became 70% real property, let's say, and 30% personal property. Okay, so there will be recapture of that personal property, even if you're going to roll forward with a 1031. However, now that you've done cost segregation and seen this giant deduction, you're most certainly going to do cost segregation the next time. And that is going to give you a giant depreciation deduction at that point, which in effect, not literally applies, but effectively is going to offset the recapture dollars that you're being hit with, that because you can't roll it forward with the rest of your building in exchange. If any of you folks have children or you advise people, wealth advising, people say, hey, I'm getting near the end. I want to give this building to my kids. What's going to happen? Well, we are giving you as the current owner decades of deductions in advance. What happens when it goes to your heir? You keep it. There's no recapture. There's no clawback from the estate, and there's no clawback from the heirs, because remember, the heirs get it at the stepped up basis. So this is a gigantic thing. If you have someone that is starting to get elderly, they plan to pass these buildings on, there is, again, no reason for them not to do cost segregation. That gives them all this cash, which of course they can give away in $15,000 chunks as gifts, again, without incurring a tax penalty, et cetera, and they're not doing anything bad to their heirs. We've got a question.
Yeah, another question came in, David. What is the minimum building value this applies to? Can a residential house qualify if you put in money to build a rental unit in it?
Okay, let me give you the basic rule of thumb is I tell people if you've got about $200,000 of basis in a building, because remember, when you buy a building, you're getting land in almost every case. So land value has to be subtracted out. But if you've got about $200,000 basis in the building, or in a case where you're a tenant, you've got about $150K in TIs, okay, that you've paid for, not the landlord. If the landlord paid for them, he gets to deduct them. If you paid for them, you do. Then that is generally going to pencil out for a cost seg study. So the vast majority of ADUs will pencil out for a cost seg study. And I tell folks, if you bought it, built it, or renovated it since about 2002, look to see if it makes sense to do a cost seg study. And that rule of thumb, about 200K. Now, almost everybody will know, but just in case, if this is your primary residence, you can't depreciate it, which means you can't accelerate depreciation. However, if, for example, you've got a duplex, you live in one half and you rent the other half, that other half is subject to this. And if you then move out, you can do cost segregation on the half that you were living in until just now. Okay. But if you are buying to live in it, this does not apply to you. This is purely for rental buildings or for buildings that businesses use in the process of what they do. So even if they're not a landlord, if you've got a tire shop that owns their building, they should do cost segregation. And the issue of passive deductions would not apply in the case of a business as long as they group it with the building. At the risk of going too deep, in a nutshell, if you have a business, tires, doctor, it doesn't matter, and you have your CPA who should know to do this, group this together. You basically make a unit saying, hey, IRS, the money I get from doing this business is all tied up with this building of mine. All of a sudden, the passive rules don't apply to this deduction. Or alternately, because you have to do that the first year, sort of like a PAD, alternately, you can rent to yourself, which is even more common. You own a tire dealership under a separate LLC, you own the building, and one LLC rents to the other. Well, that's rental income. That income can be offset with a cost seg depreciation deduction. Okay? This is normally where I get a couple questions, but I don't have to stop here. This covers the meat of what I was trying to get across to you guys. 3 important tax opportunities, all built on cost segregation, not a loophole. Even some mandatory parts of this, the IRS actually wants you to take the more liberal deductions on repairs and can penalize you if you don't. So this is the blurb about the company. None of this was an advertisement, but you probably ought to know we do this for a living, and we are the nation's premier firm. We're the 800-pound gorilla, like drastically bigger than anyone else. We've done over 30,000 engineering-based studies since 2002. We always start with the no obligation pre-analysis, and there's all sorts of benefits that we add on at the end, like helping their CPA for free to implement, answer questions, and calling me up years later for guidance. That's something that we basically price into our studies, such as, hey, do you have a smart idea of a way to replace all my windows? It turns out I do, and I'm happy to help folks. Funny little blurb that our CEO was the guy hired by the winning lawyer in that 1997 court case, my CEO engineer, who came up with the parameters of creating a study that the IRS would recognize as a good, valuable study. And then a couple of years later, he said, why in the heck am I not selling this? Started the company that I work for. We do a couple extra things, but it's pretty much cost segregation, disposition, which I mentioned, the CapEx, capital to expense reversals, that's the PADs, LED lighting and retrofits, R&D tax credit analysis, and again, we defend our study if they're ever audited. Our goal is to be a calculation resource helping owners become compliant and save money, and we partner with folks like you who are advising folks who are owners.